Hello everyone, this is Professor Kent. This is a review for chapter 7, 8, 9, 10, and 11. So this is a review for the second half of the accounting, second half of the course. I'm going to start with the first one. First one is inventory. A company can has a periodic inventory or they can have a perpetual inventory. So this question, we're going to work it out with the perpetual inventory system. When it says that Omer Anchor uses a perpetual inventory system, had the following activity for a single inventory system. So what the company is doing is the company is doing a buying and selling in the same month. When you do that, we needed to calculate the ending inventory, and then we needed to calculate the ending inventory and cost of goods sold using a FIFO and using a weighted average method. When you do that, when it's a perpetual, you have to keep track of the date. Date is important. So we're going to do the first one. First one is my first in, first out. When you have first in, first out, March 1st is my beginning inventory. My beginning inventory, we have 500 units at $2.50. The cost of these units was $12.50. Then what they did is they purchased. So they purchased, what did they purchase? They purchased on March 5th 250 units at $3.50. Was the value of these units was 875. On March 10th, they purchased 175 units at $4.50, and that is at 787.50. Now look at we have done purchasing, beginning inventory purchases, and March 10th purchase. My next date is we sold it. If you sold it, that's your next date. And what we are going to do is I'm just going to change the ink to show you how we are going to do the sold part. So if I sale, this is my sale. When did the sale happen? March 15. How many units we sold? 550 units. It's a first in, first out. So I am going to sell my first inventory that was in 500 units at $2.50. I sold 550. So I'm going to go to my next inventory and I'm going to sell the 50 units out of that inventory. So then what the value of your sale for this one will be $12.50 for this one, $175 for that one. Then going further, my next date is in the question is March 15. What did we do on March 15? We purchased. And what did we purchase? 100 units at $5.50. The value of those units are 550. We're going to March 19. So what we did, we sold on March 19. How many units did we sell? We sold 375. If you look at it, this inventory has 250 units. We already sold 50 and we're left with 170. We're left with 200 units. So we're going to sell the leftover 200 units out of that inventory at 350. That the value will be 700, but we sold 375, and my next inventory is 175 units, and we're going to sell 175 units to make up that 375. That will be 787.50. Now if I add my 1250, 175, 700 and 787, it will give me cost of goods sold. So my cost of goods sold is going to be, if I add all the numbers, it will be 291250. If I add up all these numbers, so if I add up all these numbers, what will that give me? Cost of goods available for sale. Available for sale, and that is your 346250. And if I take the cost of goods available minus your cost of goods sold, will give me the ending inventory, and my ending inventory is 100 units at $5.50, which is 550, or you could do 346250 minus 291250 will give you 550. So that's how we calculate the cost of goods sold and inventory. Now going further, now my next one was to do a weighted average. Again, you're going to do the same thing what we just did. Under the perpetual method, you have to pay attention to the date. My first one is March 1st. We have 500 units at $2.50. That is $12.50. I purchase on March 5th. How many units we purchased? 250 units at $3.50. The value is $8.75. On March the 10th, we purchased 170 units at $4.50. The value of those units are $7.87 and 50 cents. Now we're going to go to my March 5th, March 11th. We want to know what is the price that we are going to charge on the units that we sold on 550 units on March the 11th. So that's what we're going to do. So when you're doing a weighted, you're going to add up all the units up to the March 11th, and that the value is 291250. So you're going to add up these numbers, and then you're going to add up all the units that we have. It will be value of those units is 900 and the number of units is 925. You have to calculate the weighted average. How you're going to do is 91250 divided by 925. What we're going to do is we're going to get a weighted average cost. So that is my $3.15. I will sell the units at $3.15. The cost of that inventory will be $3.15. That will be the inventory, total value of the inventory that we sold will be $17.35. Then going further, what we did is if we sold it, I have to take it out of 550, and I have to take it out the cost of the inventory that I sold. Then what you are left with, you're left with 375 units. The value of those units is $11.80, and the cost that they will be at $3.15. My next purchase is March 15th, and what did we do on March 15th? We purchased 100 units at $5.50. The value is $5.50. So I'm going to add up these units. That is my units available, and if I add up these two numbers, it will give me the cost of these units. So that will be $7.30. So how am I going to do? I'm going to recalculate my weighted average by dividing the dollar value by number of units. It will give me $3.64. When I sell my March 19th, I'm going to sell 375 units at the cost that we just worked it out. $3.64 gives you 36578. You can round this to 366 if you wanted to, but you could do it to the 366 to round it off. So what I'm going to do is you're going to get a cost of goods sold. If I add up these two numbers, will give me cost of goods sold, and that is my 3098. So if I add these two numbers, will be cost of goods sold. And if I wanted my ending inventory, I have 100 units in my ending inventory. So ending inventory will be at the cost that we have it in our books. In this case, 100 units at $3.64, and my ending inventory is $364 worth left at the end of the year. So that was my weighted average and FIFO, and we're using a periodic inventory system. So that's what you're going to do. You're going to use the periodic inventory system, and that's what we calculated. Now going further, my next question is we did this in the question, we did it in the class. Similar type of question will be asked. Now what we have is we have to calculate the ending inventory balance for hockey sticks and helmets. So these are the sticks. These are different type of sticks. These are different type of um, these are the different type of helmets the company sells. So what we have to do is we have to use lower of cost and net realized value. So what they did is they told us the units cost, and this is the cost, and that's the net to realized value. So that's the cost and the net to realized value. So let's work it out the table. So first you're gonna do is we have hockey sticks, and then under the hockey sticks we have a bear, CCCM, and warrior. So what we have is we have 23 units, and then this is 13 units, and this is 57. So what we needed to do is cost the unit cost is your $95. So the unit cost is 95. This is your 200. This is 250, and my unit cost per net realized value is $200, 150, and 250. So what you're going to do is lower of, when you're doing a lower of cost and net realized value, when you go to the first line, this is my lower amount. If this is my lower amount, what I'm going to do is we are going to do lower of cost and the net realized value. So if I will take my 23 times my 95, and that will give me 2185. So that's the ending inventory. We will record it at a lower of net realized value between the cost and the net realized value. And when you go to your next one, the lower amount is 150, and we're going to take 13 units at 150, gives you 1950. Then my next one is they both are same, it doesn't really matter. So in this case it doesn't matter. 57 times the 250 gives you 14250. So it says calculate the ending inventory balance. If I add up all the numbers, that will be the balance at the end. So that's, they said to do it for both. So this will be the hockey sticks. Then I'm going to go to my helmets. Let's work it out. My helmets, we have Adidas, we have a Nike, we have Missions. So the units is 11, 10, 25. Cost is 190, 175, 75, 125, 175, and 200. So again, you're going to take the lower of both is 125. So what I'm going to do is 125 times the 11 will give me 1375, and the lower, it doesn't matter, they both are 175. So I will do 1750. Next one, the lower is your 75. What I'm going to do is 25 units at 75 will give me 1875. If I add up everything, what would I get? I will get my 23,385. So what they said is, what is the calculate the ending inventory balance. So this is the ending inventory balance when we use lower of cost and a net to realized value. So when you do the next question, it says calculate the ending inventory balance for hockey sticks and helmet using the historical cost. So we don't care what the net to realized value is, we just wanted to do the historical cost. So that's what we wanted to do, the historical cost. So at this point, so the next we have to calculate the ending inventory using the historical cost. So again, you are going to, I'm just going to erase. So when you, oh, sorry, when we are, oh, come on. So when you're doing a historical cost, I'm just going to use the same spreadsheet that I just calculated, the same schedule I just did. So what I'm going to do is I'm going to delete everything that I need for the net realized value. So now what we're doing is we are just doing the historical cost. So you have In this case, what we have is we have the hockey sticks, and then we have the helmets. Under the helmets, we have three different products. All I have to do is 23 times the 95, and what is going to give me, it will give me a value of my ending inventory. So it will give me a value of my ending inventory 2185. If I multiply it, it will give me 2600. I multiply it, I will give me 14250. Multiply it, give me 2090. Multiply it, it will give me 1750. Multiply it, it will give me 1875. If I add up all the inventory, what would that give me? It will give me a value of 24750, and that is your ending inventory using the ending inventory using historical cost. So that's my historical cost. Then going further, my next one is my depreciation methods. When you're doing a depreciation methods, there's different type of depreciation methods. So we talked about straight line, we talked about double declining, and we also talked about units of production. So it is fair to ask any one of those methods. In this case, what we're doing is we are doing a double declining. So we're using a double declining method. So we are doing double declining method, but you could be asked to do a straight line, or you could be asked to do a units of production. So when you're doing a straight line, if you were to ask this, we cannot use units of production here, but we could use a straight line. So if you're asked to do a straight line is over the life, it's going to be same depreciation every year. So before we get there, it says prepare a journal entry for 22 and through 24. My first entry is to purchase the asset. So when did we purchase the asset? On October 1st, 2022. What did we get? We get a machine. So debit will be my machine and credit will be my cash, and we paid 125,000. So that's how much we paid. Going further, my year end, the company's year end is December 31st. That is my December 31st, whatever the year is. In this case, it is 2022. So from this to that day to is my 3 months are gone by, but they are using a double declining method. But if they're using a double declining method, what I'm going to do is the formula is 1 over your useful life times your 2, because this 2 is for double declining. So then what we are going to do, 1 over the 10 times the 2, and then you have to multiply by the percentage, or if you do this will give you the 0.2. That's what it will give you, 0.2. When I record my depreciation, the cost of the asset is 125,000, multiply by 0.2, and that's my annual. We're looking for 3 months depreciation, give you 6250. So that's what you have to do, 6250. My entry will be depreciation expense and my accumulated depreciation expense, and the entry will be for 6250 and 6250. We're going to go to year 2023. Now this is a full year. I will have to do depreciation expense and accumulated depreciation, and the value will be, so I bought the asset for 125,000. I already taken a depreciation for 6250. My depreciation rate is 20%, so it's 0.2. Then it will give me a depreciation of 23,750. 23,750, and I have to do another year, 2024. My debit will be same, depreciation expense and accumulated depreciation, and that the amount will change. That will be 125,000 I started off with. My first year's depreciation for the 3 months was 6250. In 2023, my depreciation was 23,750, and now I have to multiply by the 20.2, which is your 20%. And I'm not recording, I sold it on July 1st, so this is not a full year. And I sold it on December 1st, 2024. So what we have to do is we needed to only do it for 6 over 12, and that will give me 9,500. Now they can also ask you to do an entry for the sold. If they sold it for 79,500, you wanted to know, do we have a gain or do we have a loss? In this case, it's a 9,500. If you wanted to do extra, you question didn't ask for it, but you sold. When did we sell? We sold it on July 1st. When you sell it, you needed to look at it, what is the net book value of your asset. So 125,000, we bought it, and we have an accumulator depreciation. How much is my accumulator depreciation? 6250 was for the first 3 months, 23,750 was for the 2023, and 9,500 was for my last year. I don't have a number. I'm just going to use my calculator to work out a number. Just give me 2 minutes. So I will have 6250 plus your 23750 plus your 9500. So 39,500 was my accumulator depreciation. The net book value or the carrying value of the asset will be your cost minus your accumulator depreciation. That will give you the net book value. The net book value is 85,500, but there somebody is giving you we sold it for 79,500. difference between we sold it for less. So if you sold it for less, we have a loss. If you sold it for more, it will be a gain. So when you have to do the question didn't ask for it. The cash we received will be a debit of 79,500. You have your the equipment, machinery, the asset will be sold. It will be a credit. Your machine will be credit of 125,500. You will debit your accumulator depreciation of your 39,500, and then we have a loss. If you have a loss on a disposal, or we could have a gain on a disposal. If it's a loss, it will be sitting on the debit side, and that will be your 6,000. If I add all these numbers, I will be equal to a credit of 12,500. So this is a double declining method. What if the company was using a straight line method? What will be your depreciation? So this question is not asking, so I'm just going to show you the how do we do it. The cost of the asset minus the residual value, which is your 15,000, divided by the life, that is your 10. And in this case, the depreciation every year you will do is 12,500 minus your 15,000 divided by 10. The sorry, 12500. I don't have the number. I'm just trying to work it out. Divided by 10. So every year they will do a depreciation of 11,000. 11,000 for, but we purchased the asset on October 1st. My first year we have a partial year, so my debit entry doesn't change, account doesn't change, but the amount will change. Depreciation expense and the accumulator depreciation, I will take my 11,000. This is 12 months depreciation. We have to multiply by 3 because we only had the asset for 3 months. My depreciation expense will be for the 3 months divided by 12, and that will be 2750. When you go to your next year in the 2023, debit will be your depreciation expense, credit will be my accumulator depreciation. That will be for the full year. that will be for the full year. Then you go to the 23, it will be for only 6 months. Debit will be your depreciation expense, credit will be my accumulated depreciation, and that will be your 11,000 was full year. We have to convert it into months times the 6. 11,000 divided by 12 times your 6 will give me 550. So if a company was doing a straight line, this is what will be, that's how we will calculate the depreciation. Again, you could also use a units of production method, and we did work it out, that one in the classroom, and that's your that will be, that's how we would calculate my depreciation expense. Now for this one, this question, I think in this question I forgot to give you the appraised value or the fair market value of the asset. So I think I cut and paste the question, and I realized that I didn't cut and paste the full question. So in this, the purchase price is the cost that we purchased it. So this will be given to you, and they told us the company has an appraised value which is 2.6 million, and then appraised value is 2.6 million. So then we have three assets, and we want to know how to record the assets. Appraised value and fair market value will be the same. So we purchased three assets. We have a land, we have a building, we have some storage racks, and we have fencing. So this is my building. Again, the fair value or fair value of the asset or appraised value of the asset, appraised value will be given to you. You cannot guess it. So this is 2.6 million altogether. So the value of the fair value of the land will be 1.3 million. The building will be 910,000. The 260,000 is my storage rack, and fencing is your 300,000. Again, the fair value and the appraised value is exactly the same, will be same. So if they can give you, question can give you fair value, or the question can give you appraised value. The first thing you're going to do is calculate the percentage. How do I calculate it? The percentage, you're going to take 1.3 million and divide it by the 2.6, and it will give you 50%. Then you're going to take your 910,000 divided by 2600, it will give you 35%. Then you're going to take your third number divided by 2.6 million, or the way to do is 260,000 divided by 2,600,000 gives you 10%. Then going further, you are going to take your 130,000 divided by 2.6 million. It will give me 5%, and if I add up all these four numbers, it will equal to 100%. And then what I have to multiply by the purchase price or the cost. Purchase price or cost, they both are same thing. In this case, purchase price is 2.4 million, and I multiply by 2400, and what I'm going to get it, I'm going to get the cost that I should be allocating to each asset. So this is 1.2 million, this is 840,000, 2,400,000, that is 240,000, 2,400,000, and that will give you 120,000, and altogether should equal to the price that we paid. And then what you're going to do is you're going to take your each number and charge it to that asset. So we are going to have a land, that will be debit. You're going to have a building, that will be a debit of 840,000. Next one is your storage racks, and that was your 240,000. And you have your fencing, and that is 120,000. The price they paid was 2.4 million. So that's my credit, and all these accounts my debit account. When you're doing it, you have to tell me if you're debiting or crediting, or you have to indent it. That's what, when you indent it, that means that you have a debit and a credit. Let's see what where the next question is. My next question is my payroll, and we have done a similar type of questions in our activity. So I'm just going to refresh your memory by doing this question. And the question, they told us there's three mandatory deductions that we have to pay in Canada. That is CPP, EI, and income tax. So what happens in this case? On October 1st, the Julian Limited paid monthly payroll amounts to employees. The gross payroll was 16,200, and the amount withheld from employees' checks were these or automatically deducted. So when you're calculating it, we're asking you to do a journal entry. So we're asking you to journal entry. When are we doing it? On October 30th, we're doing a journal entry. So the first entry is what we are going to, you want to know how much to pay them first. You wanted to calculate it, and then you have to do an entry. My gross pay is 16,200, so that is called my gross pay. And from that gross pay, I'm going to deduct the CPP, I'm going to deduct the EI, and we're going to deduct the income tax. And then once we deduct all of them, what we are going to do is, this is the net pay. This is just the calculate how much should be the net pay. All the numbers are given to us. 259, 2,800. My net pay is 12,339. First you calculate the net pay, then you have to do a journal entry. My first entry, this is to record all the journal entry. So your first entry will be, debit will be my wages expense, and that will be my debit, and that will be your 16,200. So then my CPP payable, and that will be your 802. Again, this is my credit. Go to my next one, my EI credit, it will be EI payable, and that is for 259. My next one is my income tax payable, and that is my 2,800. And then you have a net pay. Net pay company has to issue a payment to the employees. That will be a cash of 12,339. So that's the first entry. The second entry will be for the time company has to, this we showed you in the question, and you have to remember it for the test purpose. My second entry is, we have as a company, we have two mandatory deduction from this is for the employee. When you pay the employer, this is the employer to record the employer deductions. When we do that, we debit the wages expense. So CPP payable, two mandatory deduction from the employers are, they match the CPP. Whatever we deduct from the employees, we match the same amount, means our expense is same. For EI, whatever we took out from the employees, in this case we took out 259, and we multiply by 1.4 times, and that will give me 363. And then if I add these two numbers, it will be 1165. I could be also asked to, my third entry will be submitting everything to the CRA. So submitting everything to the CRA, how you going to do that? You're going to submit 3 deductions to the CRA. You're going to debit will be your CPP payable, EI payable, and income tax payable, and credit will be your cash. And how much will be that? You have my first entry, when you did your first entry, you had 802. My second entry also have a 802. So if I have 802 plus your 802, my second one is, my first entry, my EI payable was 259. So I take the 259. My second entry, the EI payable was 363. For my income tax, I only have it for my first one, which was your 2800. So I have to do a calculation. I don't have the number, so I'm just doing it. 802 plus your 802, and that is 1604. My EI is 259 plus 36. It is 622, and I add all three numbers together, and that's the cash that the company have to pay, write a check to the CRA. So they have to write a check to the CRA. Now going further, we have our next question. Again, this question we also did it in class, a similar question we did. So in this case, what we are doing is we are issuing a bond, and the bond question was done in the classroom too. And this one was that Kansas, a crown corporation owned by a government, issued bonds to finance the construction of the next generation. On January 1st, they issued 7%. This 7% is called a coupon rate, or we call it a coupon rate or a stated rate that is stated on our agreement. It is 15-year bond. The face value of our bond is 200 million, and the interest is paid semi-annually. So the interest is paid semi-annually. So now bond could be issued at a par, or it could be issued, when we say par is your present value of your bond and the face value of the bond, they both are 100%. In other words, in this case, if it's a par value bond, the marker rate and the coupon rate is same. So we have a present value, and then we have a face value of the bond. The face value of your bond is 200 million, and the present value of your bond will be also same. If the rate is 7%, my marker rate, when my marker rate and my coupon rate are same, the present value of your bond and face value of your bond will be same. So this is number one. Number two is, if it's not same, then we have to calculate it. How are we going to calculate it? Your face value of your bond does not change, so that's your face value of the bond, and that is at 100%. We also say this is 100. This is another way of saying it. This is also at 100. If it's a less than 100, it is 95.542. If it's a less than 100, we call it a discounted bond. So what we have to do is to the face value of your bond, which is 20 million, multiply by 95.542%. It will give me the present value of your bond. Again, this is the we're calculating the present value, and that will be 191,084,000. You could also have a premium bond. So premium will be the value of present value will be more than the 100%. And how do I do a journal entry for each one? So if I were to do an journal entry, I'm issuing a bond, debit, or a note. In this case, it will be it's a bond payable or a note payable. Either one is correct. You could say note, or you can say bond payable. And then it will be your 200 million. We record the bond at a present value. Whatever the present value we calculated, we record the bond. Debit will be cash, credit will be notes / your bond payable. Whatever the present value is, in this case, the present value we just calculated it, 191,084,000. So 191,084,000. So these were all the questions up to chapter 10. We also did a dividend question, which we did it in the class. It will be similar to what we did in the class under the activity. So this was the review. So the bond can be also issued at a premium if the value is at a 103%. The face value of your bond is 100%. If this question will give you a premium, how do we calculate the premium? You take the 20 million, which is the face value of your bond, multiply by 103%. This will be the present value of your bond, and that present value will be more than the face value. in this case 2 times 103%, and it give you 20,600,000. So your entry will be debit, will be your cash of 20,600,000, and credit will be note/bond payable. That will be your 20,600,000. So these are all the questions that can be asked, and there could be another question from chapter 11, which was your dividend, which we just did on Monday. So review that, the activity we did, review that activity. You should be okay. All the multiple choice question will be from the quizzes that we previously completed in the course. Thank you for listening. Take care and bye for now.